Hello folks, welcome back. Hope you're all doing well. So here we have the weekly chart of the dollar index. And if you've been keeping notes, we've been pretty much calling this day by day, and you might have missed how it's performing as we're outlining each day. So just want to bring that to your attention. Many times people get caught up in the Netflix and chill aspect of ICT plethora of videos, but it's important to take notes, write down what we're anticipating, what we're looking for. That way you can go into your charts, even if it's just for back testing purposes. You'll be able to see what it is that you should be gleaning from the lectures and price action. All right, so weekly chart dollar index. You can see we traded up into more of this up close candle here. Now, initially I took your attention to the opening price, which we hit yesterday. And then I said we would likely see continuation on the upside, further weakness on euro dollar, and we saw that transpire today. So the next level on this up close candle is mean threshold. Mean threshold is the halfway point from high to low. Halfway point is here. That level comes in at 104.540. Okay, so that's your level. You should have that on your chart. If we have continuation on the upside, that's the level I'm looking for. Mentioned how we would use this imbalance from this candle's low, this candle's high. That would act as support and spring price higher. And we've seen that happen here. No wipe-off required. All right, daily chart here on dollar index. Again, here's that weekly order block. The opening price is what that was. It's hard to discern what that is once we go into a lower time frame. So if I was just to show you this chart here with no reference on the actual weekly chart, it'd be a little confusing as to why I'm anchored right there when it's just really that I'm anchored on the opening price of, again, let me keep back up so that way you can keep track. That candle right there and the opening price is what this is, okay? So that's that right there. And we hit that yesterday. Then I mentioned we had this imbalance in here, and we also have a daily order block. This is this level here. Big up close candle right there in this time frame. Now let me go back one more time. See how we identified this up close candle prior to the rotation lower? The same thing now, we're applying that same logic to the daily chart. The last up close candle here with the highest up close right there. That opening price is being annotated. And you can see we hit that today, which was just outside of the scope of this imbalance here. So dollar is a little bit overzealous, and we'll see if it wants to get up to that 104.54 level. I mentioned yesterday the idea of it opening, trading down to a previous day's high, not offering any opportunity for a deferred inefficiency, which is what a fair value gap is. I dubbed it a fair value gap is because the market moves away too quickly and it leaves an inefficiency by means of an imbalance in price. So since the candles are moving higher, the imbalance is buy side. So it's buy side imbalance, sell side inefficiency. So it's inefficient in offering down delivery or movement delivered on the downside. So price rotation on a liquidity continuum basis, meaning that the price is efficiently delivered between a range of price action. For instance, if we were to look at the range between 103.20 and 103.40, that's 20 pips for euro. It's moved up, down in that range between 40 and 20 multiple times. Notice that? So if price has been moving back and forth between a defined range of 103.40 and 103.20, if we get a bias determined, which is what I'm sharing my 30 years experience with you, telling you that this is where it was going to go, and then higher still. If we ever get an opening on a candle and it drops down to a previous high. Now, normally, if this would have stopped short, like say the low was up here and didn't go all the way down to Monday's high, that would create a typical deferred inefficiency, meaning that it would go to a fair value gap protocol, something like what we've seen. Well, let me take it back up one more time. This is a fair value gap between this candle's high and this candle's low, and that one candle on the downside. That low, that high, in between those two price points, price only went down. So it's a fair value gap, yes, but a specific category is a SIBI, S-I-B-I, sell side imbalance, buy side inefficiency. So it needs to see what? To be efficiently balanced. Upside delivery. And that happens on this candle here. And then we opened and we were in this weekly candle. But I mentioned during this weekly candle's formation that we would use this as an inversion fair value gap. So it's typically viewed, if you would just watch a casual viewing of my videos, and you would think, okay, well, he says if it goes up here, it's probably going to start going down. No. That's why it's important to understand narrative. That's mentoring. Okay. You only get that from me if you spent time with me, not just a few videos. You cannot assume by watching a few videos or watching anybody else try to do it, and parrot whatever I said incompletely. You can't learn that way. You have to have a length of time through exposure and seeing it over and over and over again. But ringing in narrative, that gives you a bias, that gives you a context, a framework for a trade. Without those steps in that order, you're not going to find a trade that's high probability. You're going to be lost in the charts and you'll just be frustrated. So let's go back down to the daily chart. I mentioned yesterday, if we see this formation, and this is what I dubbed a immediate rebalance. So we opened here, traded down to a previous day's high. It doesn't mean it's the previous day immediately to the left or yesterday's high. We're always referring to the essence of inefficiency and redelivery. Fair value gaps highlight those inefficiencies and opportunity for redelivery. So, for instance, like take a look at this candle here. We have this candle's high, this candle's low, so there's a fair value gap. It trades down, but it doesn't go all the way back down to that high. Notice that? That's fine. That right there, to me, is a breakaway gap. I'll talk a little bit more about breakaway gaps in this lecture. This candle opening, it trades down and goes right to this candle's high, which is Monday's high. So it gives no room or opportunity for an inefficiency to exist. Why? Why would that happen? If we're bullish and markets are expected to go higher and it does this type of formation, you'll want to write this in your journal. This is one of the most powerful signatures for immediate dynamic price delivery. I said this to you yesterday, and if you've watched any of my older videos, and if you've been with me for a long time as a student, you've heard me refer to an immediate rebalance, and that is one of the strongest algorithmic price delivery signatures you're going to see. Look at the price delivery here on dollar. Look how fast and snappy that was. Notice that? Go back 2 days ago, and I was stating that I expected to go up to this level here on Tuesday's analysis. And then Wednesday's delivery and price, it went right to it and closed right there. But on Tuesday, I was mentioning that I'm not certain it's going to go above this fair value gap. So that gave you context. It's going to go to that level and then stop, not give anything more. The fact that we opened, traded down, and then rallied to that point, and we did our review last night, that gave me the context to tell you we're going to continue higher on dollar and lower on euro dollar. So it's still a risk off scenario, meaning dollar goes higher. Typically, that's a risk off scenario. All foreign currencies should decline more in sympathy to a higher dollar. The fact that we had this immediate rebalance and we're bullish and we're looking for higher prices, that allows for us to see directional bias being bullish. So we can be a buyer of dollar and a short seller of foreign currency. All right, so here is the euro dollar. This is our weekly chart here. You can see we've expanded a little bit further. And that weekly order block, the opening price is what I have here. And I still think that that is a likely draw, or where I think price may draw down to. And everything was reversed in the analysis last night. As we mentioned on the dollar index, we had an immediate rebalance, which is bullish for dollar. We had that same development here on euro dollar. We opened yesterday, traded up to Monday's low, and then acceleration to the downside. I took your attention to right there. I said, see those two relative equal lows? That's sell side resting right below that. Watch that. I believe it's going to draw down to that. And lo and behold, look at that. Look how cherry picked and lucky that was. Traded right down into it and pulled off that low. So the relative equal lows, the sell side liquidity here was tapped into. This inefficiency, this is a fair value gap between this candle's low, this candle's high. So this one candle between these two reference points here has only offered what? Buy side, because it's moved up. To efficiently reprice and balance this inefficiency, price needs to trade down to it, through it, or go back up. It has to leave this area once it offers a down candle passing through that same range that's shaded in orange. Okay, the blue line is that weekly order block, the opening price. So I'm expecting, let's say it that way, I'm expecting the continuation or likely continuation down into this area here. Because it's holiday weekend, it might not deliver it tomorrow, and it may need to do so next week. But I'm sticking with the bias that higher dollar, weaker euro dollar. So here's that line here from those two daily candles that I mentioned was a relative equal low, and where sell side liquidity, I mean sell stops were resting below that. You can see we did in fact dip down into that. Now last night when we were talking, the chart looked like right there, that was the last candlestick at the time of me creating the PowerPoint slides and doing our discussion. And I mentioned that there was sell side resting below here, and we would look to see if it draws down into those relative equal lows and that shaded area, which is the fair value gap, and the order block from the weekly chart there, that blue line. Okay, so we're essentially looking for that 107 big figure thereabouts. Okay, if we were not to get that at all, and say it reversed, say the dollar topped out here and the euro went lower, would this be a failure on analysis? No, because it offered opportunity to see a run from where we were last night. I said we would go lower, but it would likely go higher first for a short-term premium and then drop, go down. Listen to the recordings. Every single time I do a video, you want to write down what my expectations are. What am I expecting? What am I looking for? What would I see as a potential scenario? Okay. I will sometimes tell you, sometimes if I'm unsure, if I'm unclear, I'll be honest. I'll tell you, I'm not certain. I need more information. But then I'll say gun to my head. So if I ever say gun to my head, I'm just telling you what I think based on what price is showing me in the chart. Unless I'm saying that and I'm telling you what I suspect is going to happen, that is my hard and fast expectation. That's what I really sit down in front of the charts and I believe based on the words I'm sharing with you. It does not mean you should go out there and bet the farm on it. Okay, you're learning how to read price action. That's why you're here, and you're going to see consistency. You've seen it all week so far, and it's really a crappy week. So take away from it what you can, glean the information and understanding while spending time with me, but also paying attention to what we're anticipating in terms of direction, where it's reaching for, because that's the first skill set. That's the first thing that you need to set your mind to as a student with me. And even if you are a profitable trader doing something else, if I can help you develop that skill, your trading will improve drastically. It will increase every visibility skill set that you have in terms of reading price action beyond any expectation you may have ever held. So here's a 15-minute time frame on euro dollar, and here's the imbalance in here. And I mentioned that we would try to draw up into a short-term premium. We went right up into that inefficiency one more time, broke lower, and just worked into that eventual relative equal low from the daily chart. Dug into it twice here, and then we consolidated into the close. All right, so now we're going to look at the 5-minute chart here, and I've rung in this candle here, which is the midnight in New York. The opening price, you want to extend that through price action until around 11 o'clock in the morning. If we're bearish, okay, if we're bearish, anytime price returns back to that opening price and we have not met our objective. What was our objective last night? Well, the first thing was those relative equal lows, and then that fair value gap that's outside the range that I'm showing on this chart, which is essentially around that 1.0705 level to 1.07 big figure. At this time here, we ran up during the London session, running out these relative equal highs. See that? Ran above it, took out buy stops. Why would that be advantageous? Because smart money will take those buy stops and short against it. They will use the buy stops being ran here as counterparty to their shorts. The market drops lower and falls just short of those relative equal lows, which is that line here, okay, at 1.0713 and 2 pipettes. Leaves a fair value gap here and a bearish order block. The market trades back up just before 5 a.m., drops back down, hits an order block, down close candle, rallies once more, takes out this short-term high here, falls just short of hitting that order block, but trades right into that gap right there between this candle's high and that candle's low. Trades right into it. Then drops one more time. Where's it dropping to? Just below the short-term relative equal lows here. And then where's it go then? During the 7 o'clock session. New York time, it rallies all the way back up for a third time after London lunch, and then during the 8:30 window where the news driver comes out, the news embargo lifts at 8:30, and then we run one more time, hit the order block, run the buy stop, and trade one more time above the New York opening price. For my concept of Power 3, I teach that the midnight opening price, if we're bullish, best buys, or the optimal entries for going long, is below this opening price at midnight. If I'm bearish, and you knew I was bearish on Euro yesterday in the last few days, the best shorts are going to occur at or above the midnight opening price in New York time. So you need to have your charts set on TradingView to set to New York local time. And right now, because we're under daylight savings time, it will be UTC -4. That candle right there, the opening price is midnight opening price. We are in Power 3. We're hitting the order block, and we're wiping out buy side, and we're trading above the New York midnight opening price, while the sell side below those relative equal lows on the daily chart that we mentioned last night as an objective, where Euro would draw down into, drawing down to, in other words, it gravitates to it like a magnet. So below this line here is sell stops. Not your sell stop, because you can't probably hold a trade longer than a day because you get nervous. But long-term hedge funds have orders resting below those relative equal lows. So the market, when it went above that opening price at midnight, that offers the opportunity for smart money to sell short there, conveniently allowing the short-term buy stops that the market saw get tripped. This run up here stopped out anyone that was short running there, and then anyone short on this move gets stopped out there. So they've engineered liquidity, buy stops here, so that allowed them to use that midnight opening price. So the algorithm runs up there, allowing smart money to go short. Then their target's going to be what? What I told you last night, the relative equal lows on the daily chart. That's that 1.07132 level. And where does it drop? Just short of this one. Rallies one more time back up into the inefficiency, which is a SIBI. Then breaks hard into that pool of liquidity resting below those daily relative equal lows. If you are a new viewer, I promise you this probably seems very complicated. It sounds probably too far and lofty for your understanding right now. I promise you, if you keep watching the videos, you'll learn it. But you can't learn institutional order flow by just watching a few videos. Okay, you have to look at things and see it from the eyes of someone that's seen it and experienced it and done it for a longer time than you. And since I author these concepts, it's imperative that you take notes and look at these things in past price data. Don't take my word for something. Obviously, you can hear me say what I'm expecting in future price moves, and you're seeing it happen. But don't limit your study to just to whatever I think is going to happen next. Take your time between our sessions, go back through old moves in price action and study and look at the things I'm teaching. Does it materialize in your study? And you'll find that it does. These two up close candles here, that's your order block. It's a bearish order block. It trades up into that and then works lower once more, shift in market structure. So this right here is a model 2022 buy side, swept, low, taken. Is there a fair value gap in here? Right there. Trades up into it. You can get short there and aim for one more pass into that sell side liquidity pool and those relative equal lows. And it digs into it there. Then bounces off of that and we consolidate into the close for the day. All right, here's a 1 minute chart and we're dialed in on that actual run into the sell side. These are that relative equal lows on the daily chart, that level right there. And we're viewing euro dollar from the perspective of a 1 minute chart. You can see that up here. So here's our sell off here. Breaks lower, relative equal highs, relative equal lows. You see that? So we're creating this little trading range with the biases being what? At that time, all during this consolidation, we're anticipating, as I mentioned last night, we're wanting to see euro dollar trade down in that sell side liquidity. I mean, sell stops resting below 1.0713. It drops aggressively down into that right in here, then whips right back above it. Trades one more time down below it, but only to consequent encroachment, which is the midpoint of this gap from this candle's high to that candle's low. Measured on your own. The Fibonacci is that level right there, and it hits it. Then we come back to life, rallying higher. Short-term high. So once this liquidity below those relative equal lows on the daily chart is engaged, we can anticipate what? The market to want to pull back inside the range. We're seeing it do that. What's left up here? Buy side liquidity. There's buy stops. Who would look at this as retail resistance? The average trader that reads a book, watches a few YouTube videos, and they think that everything works on these imaginary support resistance lines. So they're going to trust this and be short, thinking, okay, I can put my stop loss up here. What kind of stop? A buy stop. So it protects them. Well, the market quickly runs for those buy stops because the algorithm does not want them to pull their order. Smart money distributes their short position and buys up here and then adds for a long here to ride it up to these buy stops. We have an order block up here. Trades above, trades back down into a breaker. Low, high, lower low. The highest up close candle is right in here. Take that range on your own chart, extend it forward, returning back into that bullish breaker, trades up into it and hits the order block there. Then we consolidate, going into London close. London close is between 10 o'clock in the morning to noon. We get a fair value gap here. Multiple times, this is time distortion, where it just stays inside of a range. It's already priced in the high. Just stays in that range, doesn't work outside of that. Look at the bodies. The wicks will go just outside that fair value gap, but that's okay. It's permissible. And then we would expect it to trade lower again, reaching back down into the daily relative equal lows again. Here's that move here. So we have 10 to 11, your fair value gap after hitting the order block. This would be your fill, but you could have multiple opportunities to go short, trading for the New York stop run. So where would that be? That low right here is where stops are. This is the most energetic run prior to New York lunch. New York lunch is 12 to 1. So here's 12 to 1. Prior to that 12 o'clock, where's the most energetic price move on the upside? Right there. So what is that going to be? That's the target. So the algorithm will run down, create a fair value gap, trade up in here, breaks lower, fair value gap, hits it, institutional order flow entry drill, which is a partial entry into a gap that does not completely fill, breaks one more time, gap, order block, 2 consecutive up close candles, trades into it perfectly, drops one more time, that low takes out that low right there, then it springs back into the range. That range right there also, if you look closely, is a breaker. The lowest down close candle, high, low, high, extend it forward. There's your range. These 2 consecutive down close candles make up one order block. The order block here is the breaker. Why am I not using this one? This candle went lower, ICT. You're using the candles that have the lower body. This is the lower body. Also, this is also occurring right immediately after the high. I would not look at this as a breaker otherwise. For instance, let's just say that this body here didn't go as low as the close it has in this candle. Say it was closing higher than that candle's close and was up here. I wouldn't even refer to it as a breaker there. Wouldn't even refer to this at all as a breaker if it did that, but because it did this, high, low, higher high, remember the wicks do the damage. So I'm going to look at that wick and discard it. It's a 1-minute chart. So you can't refine much more beyond that if we're looking for a range for defining a breaker. Okay, so high, low, higher high, 2 down closed candles, extend that forward. We're seeing it trade up into the breaker there and right there as well. And then we see price reach back one more time below the low prior to New York session lunch, which is noon to 1 o'clock. You thought it only worked in ES and index futures, didn't you? No. Okay. So it runs in here and then back inside the range. All right, E-mini S&P. This is our weekly chart here. You can see we traded down below last week's low and we back inside the range. On the daily chart here, you can see we worked inside that sell side liquidity pool, as I'll show you in the lower time frames. This rectangle will be much more meaningful to you when we drop in the lower time frames. It's simply the opening range gap. But I want you to take notice of how the bodies of the candles here, the open of this candle here and the open of this candle here is right at that opening range. And again, it'll make much more sense when we go on lower time frames, but we're just trading up inside this inefficiency here. So it'll be important to see if we reject that overnight going into tomorrow, or if we power through that and completely close it. If we trade above the gap between this candle's high and that candle's low, if we trade above it, I would treat that as a inversion gap, something that's bullish. Right now, I'm looking at it as a potential area just to get short and look for lower prices because we have 1, 2, 3 relative equal lows here, and that sell side is really, really juicy right now. We've already seen this 1, 2, 3, 4, 5, 6 times go higher. So this to me looks a little too tempting for a run down below that. And yes, it's a lot, but we have a lot of time between now at the time of this recording and the Friday's close, and especially if we continuously see the dollar index rallying higher. All right, here's the hourly chart on the S&P. This was the sell side liquidity pool I mentioned that we would draw down into if we failed to find any support. We got that as well. Look at the bodies. I mentioned that yesterday evening. And then yesterday I told you that I'm expecting it to draw up into a closure of the opening range, and you'll see that in a minute, but also up to the buy side right in here. Okay, go watch the video from last night. I've added it to the playlist for the 2023 mentorships. Every time I do a video, if it's a live stream, I have to add them to the mentorship playlist. Like this one here, I'm recording it, pre-recording it, and showing everything that we talked about last night came to pass, and it'll just fall in the ICT Mentorship 2023 playlist because I put it there. But a live stream, like you just can't go to my YouTube channel and just look at the last video. You won't see it there. You have to go click on the live tab. But to make it easier for you, I've added the live streams that I'm doing in the Mentorship 2023 playlist. So as I do them, as I create them, they go right into that playlist. So if you want to bookmark that playlist, you'll have all the videos I'm producing this year that are mentorship grade. All right, so here's Tuesday and Wednesday's opening range gap, and you probably remember that yesterday. And I'd like to keep opening range gaps on my chart for 3 days. Okay, so that's one of those opportunities. If you're not paying attention and you just let me say it and you don't write it down, it's one of those gems that just simply will not make it in your understanding. But after 3 days, it expires in my mind. Okay, and it's all part of my Power 3 concept, which I'll teach more about later. It's not just simply the open, high, low, and close, or the accumulation, manipulation, to distribution. It's not just that. It's much more than AMD. Tuesday, Wednesday, opening range gap is shaded here. That's what we were seeing on the daily chart. Notice that from Tuesday crossing over to Wednesday's opening range gap, it was still being respected on Thursday. Look at that. Look at the respect of it here. Look at this candle's high. Look at the bodies in here. See that? So there's a whole lot more going on behind the scenes that is algorithmic, that unless you know about it, it's completely, you're completely oblivious to it. The average trader, the average person that understands gaps, they don't think about the market like this. And that's what separates me from everybody else. If you want to be an apex predator, you have to hunt differently. You have to be the first one to take the prey. You can't wait around. This is not the second mouse gets the cheese. Okay, we're not mice. We're lions. We're going out and we're taking it. So the buy side is what I told you we would reach out for yesterday, right up above here, and that we would trade up into the high end of that gap. Okay. Yesterday we were talking. It was right about in here, and then we opened up here, traded down at 6 o'clock, and then we meandered around and then found our way up to it and above it, fell short of the buy side liquidity here. So the objective is what? Still run no stops. So it comes all the way back down to the low of that opening range gap from Tuesday and Wednesday. Now, I'm sure you're probably scratching your head if this is the first time you watch the video. What am I saying a Tuesday to Wednesday opening range gap is? Where do I get that information from, right? You have to change your chart to regular trading hours, not electronic trading hours. And you'll see the separation between the settlement price and the opening price on the new day. So this is what happened on Tuesday, and we have one here also. Okay, so I'm going to add this one. I'm going to change this one to a different color. It'll still be on the chart because it's very important you understand what's about to happen here. It's shaded in gray. So it's there like a ghost behind the scenes. No pun intended. The ghost in the machine. So we have the opening range gap for Wednesday, Thursday now, which is this now broader range. So there's an overlapping of those two opening range gaps. I promise you, you will never see that in books anywhere. Now, there's going to be people out there that hurry up and run out there and print their books on Amazon and talk about this because I've said it today. But this is the first time I've ever taught this. Even my charter members don't know this. So today, the 25th of May, 2023, I'm teaching you something that I've never given to the public before. So I want you to appreciate this. If you run around on your YouTube channel and create these mentorships of your own, okay, and you pretend that you knew this beforehand or have you always been doing it, you're going to look a little foolish now. So after we get this opening range gap here, the old one, Tuesday, Wednesday, we open above it, trade down, and find support at the lows of it. You see that? But it didn't fill this. Why? Why didn't it fill that? Because it has unfinished business. Where's that unfinished business? The buy stops up here. Ran up there, hit it. Now we have a gap. Just like we were treating yesterday's Tuesday, Wednesday opening gap, we had some portion still to fill in. Now we can look for this area here to potentially have a event fill it in tomorrow or reprice to it. And that's my expectation going forward. I probably am wrong. Okay, so don't put too much weight or emphasis on it, but that's how I look at it. We're going into a holiday weekend. Anything can happen. So I'm really not even doing a video tomorrow. I'm not going to be looking at the market tomorrow. We're going to be doing something for our family. So I could care less what the market does. But if you're going to hold a gun to my head and say, ICT, tell me right now what you think, I think that we're going to try to make an attempt to get down here and work towards this area here. That's what I think. Okay, if I'm wrong, it would need to go back above current new week opening gap high for me to be bullish again. There you go. So now we have both of those gaps. We have Tuesday, Wednesday opening range gap, and we have the Wednesday, Thursday opening range gap. And we're back down here on electronic trading hours. So you can see there's relative equal highs. I said there was buy side last night. Go watch the video. That's where I think it's going to draw to and get to the top of that old Tuesday, Wednesday opening range gap. Well, we did that here. Then we fell short. Notice what we did? We went above the range high there, but we didn't get to the buy side yet. Then it dropped all the way down to the low of that gap. See it? Follow it along. You still see it in here, and then boom, it's gathering all kinds of new orders, but not by itself. Look closer. What is this? It's a fair value gap at the lows. So smart money is accumulating right in here. Market rallies up, comes back down, one more tap, and then takes off, trades into a buy side imbalance, sell side inefficiency, which is a fair value gap, and order block right there. Where's the target? The buy side I told you last night. Wham! Hits it beautifully. Does it continuously keep going higher? No. It rejects it, comes back down into the range, buy side, rallies one more time, pumps in, and then fails once more. So I'm watching to see if this potential phantom trend line here breaks, and if it does, we'll be looking for the sell side here, below here, and into the gap that would be otherwise expected to normally fill. But again, it's a holiday weekend. Anything can happen, folks. The volume will be different than it normally is. There's a lot of people that simply are going to go away. They're not going to be trading. They're not going to be doing anything. So bear that in mind tomorrow. All right, so now we're on that 5-minute chart, and we're ringing in the new day opening gap. Good grief, ICT. How many gaps are you going to talk about? All the ones that matter. Okay? So the new day opening gap, and I taught this on the YouTube channel, so take a look at that. You'll find it in the video playlists for the 2023 mentorship. New day opening gap, NDOG, NDOG. So we have the closing price at 5 o'clock, and then we have the opening price at 6 o'clock. So that hour separation is what we're showing here. That's your Wednesday, Thursday, new day opening gap. Extend that throughout the day. You can see how we get consequent encroachment of it here and then sells off. Consequent encroachment is half of any inefficiency or gap. Mean threshold is half of any order block. There's a distinction there. It's very important to keep that distinction and understand it. Then we fall just short of hitting the top of it here. We work outside of it and then rally one more time. Notice that in this little area right here, we're hitting an order block, but we're also in consequent encroachment of the low and the high. Remember that gray shaded? That's the Tuesday, Wednesday opening range gap. That range here, split that in half. That's consequent encroachment. That's what you're seeing right there. Order block, consequent encroachment of Tuesday, Wednesday opening range gap. Rallies. Yes, I'm going to have a specific tutorial video for opening range gaps. But I have to teach it. I have to prove to you a conceptual idea. I've done this in my live streams. I've talked about it also in analysis. But I'm giving you the foundation. And then when I give you a lecture, it'll be like, oh, he's pulled all those loose ends together. Now I can see what he's talked about now. But that's consequent encroachment of that. It rallies, small little gap in here, trades down into the low end of the new day opening gap for Wednesday, Thursday. That's this one over here. And you can see real quickly, unless you have these things on your chart, or as I have them written down. I look at the chart and I have these levels in my notes. And you're probably wondering, like, can you show us your notes? It's just simply these prices. That's all it is. And labeled what it is. It's not going to mean anything to you. But I've been doing this a very long time. So I know the levels I'm looking for, and I'm looking at it in terms of time. So what's so specific about this here and this here? It's occurring around that 8:30 news embargo. So we had news to come out, and then we have the impulsive price leg that runs up, retracement, runs again, it falls short of our objective, then crashes all the way back down into an order block here, And it's also the low of what? That Tuesday, Wednesday opening range gap low. And that shaded area here, see it? It's lining up right with that order block, digging into it, and then rallies one more time, and then finally blows out the buy side that I told you last night would be the objective for today's trading for Thursday, May 25th, 2023 for ES. We slipped lower, consequent encroachment of new day opening gap. That's this gray area. Rally one more time to run into the rejection block, which is the highest up close candle here. And I know some of you are like, man, this is way too much information. You don't need all this. This is just 30 years of experience in my models. These are my tools. These are my concepts. I know this stuff like the back of my hand. You only need one thing. You need one setup. I'm giving you a plethora of setups to work with. It's your job to find the ones that match your personality, the one that makes the most sense to you. Not all of these things are going to make the most sense to all of you. In fact, it might be just one or two things that I ever teach you that you're like, okay, I understand, that's amazing, that's great, but this is all I need to find my setup and I can make money on that. That's what your job is here. You're not trying to take everything I know and press it into every single chart that you're looking at, because they won't always appear. A breaker's not always there. A mitigation block is not always there. An institutional order flow entry drill is not always there. So you have to, keep in mind that you're still being expected to bring your own personality into this. And the way I teach and the way I mentor, I allow for that. I'm not trying to, with an iron fist, say, this is what you're going to do and only this, because that doesn't work. Now, there's people out there who will say that I do that, and they're lying, because I don't do that. I give you many ways to skin this cat. And like I said many times before, I could create a new model every single day for an entire year and still not run out of yeast. This baker does not run out of yeast. I could literally bake cakes with profitability for the rest of my life. It would look completely new and fresh every single time you sat down with me. 30 years of insane study and insight that you would never glean anywhere else. That's what you're seeing here. It doesn't mimic anything else. It's not supply and demand. It's not Wyckoff. It's not any of that stuff. The market's reaching for inefficiencies and liquidity, and it's doing it on a time-based delivery schedule. That's it. That's all it's doing, folks. Now, if you remind yourself continuously that that's what this is about, it will remove that tendency for you to reach and say, oh, this is too complicated, because it's not. It's not complicated. I'm just showing you everything available to you, and you have to see, okay, this time of day is what I want to trade. And this market's what I want to trade. And this setup is what I want to trade on. This framework is what I'm hunting in the marketplace. If it's not there, I do nothing. But it will exist at least once or twice a week. And that's enough. The problem is you want every single session, every single day. You want to be in every swing. You want to be able to justify why you're not in a move every single time. And you want to know you're in every move that makes money. And that's impractical. And that just shows infancy as a trader. I felt that there was a way for me to do that too. And even with everything I know, I can't be in every move. I have to sleep. I have to do things with my family. I'm just not interested in looking at the charts. And that's the reality. So you can't put that much pressure on yourself. So let's keep on going here. All right, so now we're going to get into some order flow. And this is going to be a little bit in depth, and just bear with me, because this is probably going to be one of those videos at this point you want to come back to at a later time. Come back to this one a couple times this year. Like every 3 weeks, come back to this one, and you'll see that you understand more about what I'm talking about here every time you do it. It'll seem like a brand new video each time you look at it and listen to it, because you won't be able to ferret out the information I'm showing you, because it won't mean anything to you the first time listening. For the older students, people that have been with me for a long time, this is going to be a little bit more in depth. All right, so we have the 10 o'clock to 11 o'clock silver bullet hour in the AM session. This is ES on a 1 minute chart. And you can see at the high end of that old opening range gap, we're opening and then slamming down. Remember, we fell short of the buy side liquidity I told you we were going to go for. So we went outside the range of the opening range gap. And then right here, we slam lower, trade down into an order block. Remember the order block I showed you? before we go into the slide here, let me go back up. That's this one here, okay? The blue line is that order block right there on a 5-minute chart. On a 1-minute chart, that level right in here, what we're studying is the 10 o'clock to 11 o'clock time. And give me one more time, go back up to that. 10 o'clock to 11 o'clock, we're looking at this price action here. What's being shown on the 5-minute chart here, we're zooming into all this little area here on a 1-minute chart right here. Now all this, we're going to magnify it and looking at it on a 1-minute chart. So we're in that same area here. So the market drops down. We create a fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. That's this move here. We create relative equal highs and relative equal lows. It trades down. Remember that shaded area here? This is the low of the old opening range gap, Tuesday to Wednesday, and Tuesday to Wednesday's opening range gap high. We're trading at the low of that old Tuesday, Wednesday opening range gap. Hitting it here, hitting it here. Look at the bodies respecting it. We just go outside of here, and then we run these relative equal lows there. The wicks are doing all the damage. Then we quickly run back up, take out a short-term high. Oh, now we have something right. This is the 2022 model that I taught on the YouTube channel. Take stops, shift in market structure, fair value gap, buy it. That's your silver bullet. Ooh, so I can blend the 2022 model and the idea of the ICT silver bullet, blend it together, and this is what you do. It isn't always going to be a continuation. You're going to treat it sometimes with a reversal, and this is what you're looking for here. You can buy it here. These arrows are just for illustrative purposes. These are not executions for disclosure's sake. I'm just showing you where your entry would be. This is how you want to do your own journaling. You want to, like in areas over here, or over here, or up in here, you want to annotate and reward yourself with positive self-talk, saying, it was amazing to see this pan out the way I was expecting it to, and you see this. And then when you look at it week end later, or the week later, or a month ago, you go back and look at your old stuff, and you'll read that, and your subconscious remembers that as pseudo experience. And the way you condition yourself with positive self-talk, never putting anything negative in your journal entries, you're conditioning yourself to see the positive aspects of these types of things in price action. And you trick your brain into seeing it like you actually did it. And by doing that, it helps fuel your motivation, and it removes the uncertainty because you're training your expectation and your understanding and your subconscious to recognize these things quicker by doing it. Versus if you just watched price action and leaned on somebody else to point things out to you, when you're back testing and you're studying and you're journaling, you want to really put some work into this. You really want to do, this right here is better than most technical books. I have books that I spent $400 on, and they are not this annotated. They're not that detailed. I took my 30 years experience and what I look for in price action, and I applied it to this. These types of charts or examples of fractals and price action, this is what you want to treat this like meditation. And the more you put into this, the better you're going to be as a technician. And that technician will make you the better trader than you've ever imagined. But you have to do this step, folks. You can't just skip over it. There's no way you can learn how to do this without doing the back testing and journaling and studying. It has to be done. And if you don't want to do it, then just simply expect you're going to fail. Okay, and that's the honest truth, and there's no sugarcoating it here. I don't ever do that here. But if you're trying to do it half-assed and trying to do it and not really putting an effort into doing it right, you're not going to be successful, and you have nobody to blame but yourself. But there's two opportunities here for the silver bullet. You have this one here where it trades down into it, and then we have this one here, and it rallies up, takes the buy side here, and then runs into the bearish order block, and it doesn't even need to trade outside of that old range on Wednesday, Thursday's opening range gap. So we have profitability and being incorrect. Remember, we're aiming for the buy side. Wait a minute. You just said we're wrong and we can be profitable? Yes. Remember the rules for silver bullet. For ES or index futures, it's got to offer at least a 10 handle range. Well, if you're buying it down here at 41.42 and you're expecting it to go up to the buy side, that's the best case scenario. But you also have these gaps in here, this shaded area one here, and you have this one here. So you have Tuesday, Wednesday, and then Wednesday, Thursday's opening range gap. The algorithm will refer back to those same levels, folks. Okay, it's not just doing it today and yesterday. It's going to do this in perpetuity. Every day in the future, it's going to remember these levels up to 3 days. Sometimes it'll refer to it beyond 3 days, but if you use 3 days as a general rule of thumb, it will serve you well. After 3 days, take it off your chart. You do not have all these on the same chart. You have to create templates, and templates are useful. So you have a template that has all of the opening range gaps. So that way you're toggling. This is what I'm talking about when I'm telling you that I have 12 different monitors and I'm constantly referring to everything and cycling through everything. I'm looking at that the whole time I'm talking to you. When I was doing those live sessions and calling the market live, when I'm doing it with Twitter and I'm saying this is what you're looking for, this is what you're looking for there, I'm constantly getting information and intel referring to these levels while prices, marching along and ticking away. I'm not reacting to price. I'm anticipating it. And you, as a student of mine, you're going to learn how to anticipate too. You're not reacting to price. Retail traders react. You're essentially a breakout artist. That means you hope something happens, and when it does, then you can react to it. No, we're anticipating specific things to occur, and when it does, we're already there. We're meeting price right when it does whatever we're looking for. We're buying when it's going down, and we're selling when it's going up. That is completely diametrically opposed to retail-minded traders. And that's not to, be condescending to anyone that trades with retail logic. It just means that there's a huge chasm separating what it is I'm teaching you to do and how to interpret price action against everything else out there. It's light years beyond everything else, because this is the market. This is exactly what the market's doing every single day, and this is why I'm accurate. This is why you see me call it beforehand, and it happens, and my students have learned from me, and they're doing it too. You see them out there doing well. They're not making 9-to-5 type income. They're making 6-figure plus. And if you want to learn how to read price action, my way of doing it, it's going to take a lot of effort, and you got to be easy. But the rules were it has to be at least 10 handles or 10 points. Points or handles in futures is the same thing. I'm an old guy. I've been around for a while. And when we talked about futures or S&P, every full handle move or full 1 point move, which is 4 ticks, we always called them handles. And it's interchangeably used sometimes depending on who I'm talking to. If I just been asked recently by someone, what's a handle? What does that mean? It just means it's a full point move or 4 ticks. But the criteria for a high probability trade in ICT Silver Bullet is in futures, it requires at least the potential to see a 10 handle run. Well, if we're trying to buy it down here and we're using this as the best case scenario, if we're trying to get filled there, all it needs to do is print 41.47 even, and the spread would fill you. So you could be long at 41.47 and a quarter. If it goes up 10 handles, where's 10 handles? That's 41.57 and a quarter. That would be right here. And we're not even outside the opening range gap. We're just seeing it at the high of the new day opening gap. So it definitely is a high probability trade to be going long here, because it offers opportunity to even get 10 points or handles before it even gets up to here, which is where we're trying to get to. So we can find profitability by taking buy-side liquidity, taking a partial, entering here, taking a partial here. You can pyramid here. So you can go in, like, say, for instance, if you use like my model, go in with 6 contracts. I'm not suggesting that you should trade with 6 contracts, by the way, but if you're trying to pyramid, okay, or if you want a pillar. Pillar is like buying 1 contract, buying 1 more contract, selling 1 here, holding on, and then selling your last one, and then stop out, because you would be trailing your stop loss. Stop loss would probably be right below this swing low once it got up into this area here, because if it's going to reverse, it's going to reverse there, but you don't want to just collapse it, because it could have very easily ran up in here at the buy side, but it didn't do it. It came all the way back down into the low of that order block once more, route again right to the high of that old Tuesday, Wednesday opening range gap. That's that shaded area here. See it? It's a ghost image. And then it drops back down to the low of the new day opening gap. And then consequent encroachment of the opening range gap of Tuesday, Wednesday. Here's the high of it, that shaded area, and this is the low of it, trading down to midpoint of it. and then accumulate more, sending up to the high of new day opening gap Wednesday, Thursday. That's this orange shaded area. And then moving into the afternoon. This is a 15-second chart of what I just showed on the opening range and new day opening gap and the silver bullet between 10 and 11. I read a guy, he left a comment on someone else's video. I'll just kind of paraphrase it, saying the thing that's wrong, or the thing that's not cool about ICT is it's complicated, and I'm the only one that can use it. And I pull out silver bullets over here, over there, and it's like a WTF comment. He feels overwhelmed. Okay, and I don't know if it was just a guy that was genuinely sincere, just saying I'm frustrated and I want to do it, but it's just too hard, or if it's someone that's being a typical troll and whatever. But if you have that same mindset, okay, I strip price down below a 1 minute chart. I've said this. I talked about this in the Twitter spaces before I actually did the Silver Bullet teaching. I taught Silver Bullet in a Twitter space, which is like a podcast, vocally, just talked about what it is and how it looks and where it forms. Then I taught the lesson, the lecture. That's just an introduction. There's a lot more to it, and I'll build on that as we go throughout the year. And I'm doing it actually here. But what time frame do you look for? Where's it form? It's a fair value gap that forms in between 10 o'clock and 11. It trades into a fair value gap. It does not need to be a fair value gap that forms between 10 o'clock and 11 o'clock. It could be a fair value gap that was prior to 10 o'clock. The entry is occurring in that window of 10 a.m. New York local time to 11 o'clock New York local time. Everything that I showed on the 1 minute chart, let me go back up and show you this again. Look right here. This is a 1 minute chart of the silver bullet here, and this is the silver bullet here on a 1 minute chart. Okay, a lot of overlapping in here, and then finally it leaves the range and it creates this fair value gap, and it trades down into it and it runs away. Let's go into this information a little bit more detailed, and also I want to look at all this imbalance here. Okay, why is it going up to here and stopping? Look right here. Here's your order block here. It went past that, beyond it. What's occurring in here? What is all that about? This is institutional order flow. You're not going to see it on a volume profile analysis. You're not going to see it on depth of market. You're not going to see it on a ladder. You're not going to see it on level 2 data. All these things that you think makes you institutionally minded, it doesn't. It does not. All that stuff can be spoofed. What I'm going to show you here is how it never surprises me. It never jumps off the chart and says, oh, I got you, ICT. You didn't see that coming, did you? So think about what I'm showing you here. Study this for a second. Pause the video. Okay, really pause the video. Study everything you see here and all this movement down and where these silver bullet entries are occurring and where price reaches up here. It doesn't look obvious here, but when you drop down to a 15-second chart, which I'm about to do now, so if you're not ready and you're still looking at, don't play it, keep it paused. So you never pause the video. You're missing out on an opportunity to learn. But back to that 15-second chart. Here's that sell side imbalance, buy side inefficiency. Okay. All this run down here and then into this low, we create those relative equal lows. We go down below it shallowly. That little shallow run tells me that any retracement higher is just going to be one more drive lower. And what does it do? It runs right back up to some random level, right? No. That fair value gap right there. See that? It's also a mitigation block, which is this down close candle. High, low, lower high. It's a reversal of sorts on my breaker pattern. So typically a breaker would be a high, low, higher high. A mitigation block is the down close candle in between the high and lower high. So it's trading up into that there and in an imbalance there. And then drives harder. So that's taking out the sell stops here. So it engineered it. It went low, low, created retail-minded support. They're going to buy it. It rallies up, they feel rewarded, and then it comes back down. They may or may not have been stopped. It doesn't matter. Now, if they didn't have a stop, they're really going to put a stop loss there, right below those lows, in that low, in that low. And then you see it go wham, spends time down there trapping traders. Then it rallies, takes out a short-term high. That's a shift in market structure. Creates a fair value gap on the 1 minute chart, but look closer now. This is a 15-second chart. ICT, come on, bro. Seriously? Like, I'm not looking at 15-second charts. Okay, then this lesson isn't for you. I've already taught you how to trade using the model 2022. You don't need this. You don't need this to make my stuff work. But if you want to be a freak, okay, if you want to be a freak in technical analysis, no, slash that. If you want to be a freak in technical science, because that's what I teach, okay, we do technical science here. It's not contrived, it's not conjecture, it's not guesswork. We have this down to the smallest degree and the highest degree of precision. Look closer. Inside of that shaded area on a 1 minute chart is a fair value gap, but you don't see that as a fair value gap here on a 15-second chart. In my charts, in my monitors, I have one monitor that I use and I dub it as a intraday matrix where I'm toggling through constantly. Just by a couple keystrokes, I'm going through 5 minute, 4 minute, 3 minute, 2 minute, 1 minute, 45 second, 30 second, 15 second, 5 second. I'm looking at charts just like that as I'm looking at key levels. So when we're in this institutional area here where orders would be resting, what kind of orders? Sell side liquidity. Then it rallies up and we have a shift in market structure. Wonderful, because I'm expecting that buy side liquidity, which is outside the scope of this chart here. Remember, it's above. That's where I think it's going to go. I told you that last night. This 1 minute imbalance here that's shaded, it doesn't look like a fair value gap here. But what is overlapping on a 15-second chart that's still useful using what my PD array matrix taught you in the core content on my YouTube channel? 2 down closed candles is a bullish order block. Extend that to the right. We're digging down into that order block there, rallying and coming back down into it again. There's an order block and a fair value gap. That right there, if I didn't buy it on this pass here, I would see that and be going long. And I would buy it again here and adding more to it in pyramid. That's why you see me sometimes entering, and it's like, why is he buying it? Like if I'm going long, for instance, I'll do executions and I'm recording it. I'll go long, buy it, and then a couple seconds later, I'm buying it again. And it's like, what is he doing? It's this. I'm buying it here, I'm buying it again, and I'm adding it here. So it's like 6 contracts long, 4 contracts long, 1 contract. Or I'm sorry, 6 contracts, 3, and then 1. That's my 10 contracts. So it's 6, half of that's 3, and then there's no half of 3 that I can do. It's 1 contract. So that's my standard 10 lot model where I build in. If I think the trade's good, I'll do that. Well, if I don't see the lower time frames doing this, I'm not going to do those real close proximity entries where I'm showing you multiple entries generally in the same area. I'm dialing in with a very small sub 1 minute contract basis, and it looks just like this. But you're not seeing it because you don't have a 15-second chart or less than 1 minute. TradingView offers that. I don't know what program or package you have to get that, but I'm the highest level membership there, so I think it's like $600 a year. But if they do the same thing they did last year on Black Friday, you can get it really cheaper than that. But if you don't want to spend $600 to have this kind of information, or you can't get it somewhere else and you don't want to pay for the data, forget trading. Because if you don't want to invest in the tools to be able to do these types of things to this degree of precision, you're probably not going to do well. Okay, there's no free way in this. Okay, I may be teaching for free, but it's still going to cost you something. It's going to cost you time, which is very expensive. It's going to cost you money in resources in some kind of platform. And if you want to have the degree of precision that I teach and make available to everyone with my teachings and lectures, this is one of those things you're going to have to reach into. You can't just simply look at just a 1 minute chart and think you got everything that I've taught, because I'm below a 1 minute chart on everything I trade. Everything. And I'm looking at these types of things here. Same thing here with that silver bullet up here. This range is a 1 minute fair value gap. You can't see a fair value gap in here. You see this down closed candle though, don't you? So when it's trading down into that, that's where I'm going long. I'd be buying that order block right there. And then as it was dropping down, if it would have hit that again, that shaded area right on here, on the 15-second chart, I would add to it there. And the market runs up. Look a little bit closer now. Look at this inefficiency. All of this movement down here, there's pockets where there is only one candle passing through. We have this small one in here. We have a small one right in here. All of this here, one candle passed through, one candle passed through here, and right in here. This one here is essentially repriced to right there. And it's rebalanced because it's left it here, here. So this was of no interest to me. This one gets filled in and repriced and balanced because it's back and forth inside of this area here. So now that's balanced. If we rally above that high, then we should have no problem going higher and not ever need to go back below that high. What I just said is huge because everything over here is telling you the narrative that needs to be displayed in price delivery. Once we have this back and forth movement, that means it's efficiently been balanced. Once it leaves it, that means goes above it right there. It never needs to go back below this high. Does it? Not until it goes above and rebalances into this area here. This range here is this price formation. It reaches up into that, then pulls back lower. This range in here, it trades up into it here, finds support at it, and then rallies above. It does not need to go back below this high. It's acting as support, rallies up. Again, as I taught last night, if you want to understand what classic support resistance is and what it means for you to look at it in charts, and you don't want to be this in depth, you don't want to be a technical science major, you want to see simple trading, then you look at these inefficiencies around levels you would expect as support resistance. And if you see the things I'm teaching you here, you'll probably be safe in trusting that as a support or resistance. Doesn't mean you're going to be 100% accurate. It just means that if you're trading with support and resistance ideas, if these inefficiencies that are to the left of the chart are balanced, not just repriced to, when they're balanced, that means up and down price delivery, and then it leaves that range. Then it becomes a real balanced price range, and then you can trust that it won't go back through it. It'll act as either support if it's going higher or resistance if it's going lower. You can see that area here. They work this level here back and forth. It's balanced once it leaves it. So then all I need to do is see it trade above it. That high right there gets traded above it, comes down, never sees it again until we get to this area here where this is inefficient and it's been rebalanced. This candle here trades down, then it opens, trades down, up, and leaves. That range is the only exposure for inefficiency because this candle went up, this candle went down, this candle opened, went higher, and then back down. So this range here and higher to that high it's balanced. The inefficiency is this candle right there. So that's why it only went right up to that, to the tick, 2 candles, and then plummeted down to new day opening gap low, and then down into, which is a little bit to the left, I'm sorry, to the right of this. It's not in the scope of this fractal being shown, but it's the consequent encroachment of the Tuesday, Wednesday opening range gap. All right, here's a 1-minute chart on the E-mini S&P afternoon session between 2 o'clock and 3. This is your PM session silver bullet. Now here's where we've seen the price rally up and go into our objective. This is the high side liquidity pool I told you that it would reach into last night before we got there today. It did so during the 2 o'clock hour. It ran through it and then broke hard lower, leaving this inefficiency right there. The market trades up into it. That would be a short for a silver bullet because we hit our objective. We broke down and we could look for this inefficiency here, and it has a real gap. You see that? This, friends and neighbors, is a real liquidity void. That is a real liquidity void. This is not a liquidity void. This is not a liquidity void. Okay? This is a liquidity void. Where this candle stopped and this candle started, that separation there is no price data being printed at all. No trades existed there. So when it did this inefficiency lower It's a fair value gap, yes, but it's a SIBI, sell side imbalance, buy side inefficiency. That means it's lacking what? Buy side. That means a candle or candles must go up in price delivery in that range. We see it return back to it here, and this would be a short, expecting it to go back down into this inefficiency and trade to that real liquidity void. It one more time pumps up into here, doesn't even get back up to the first silver bullet fair value gap, breaks again. There's a small little gap in here, and I would counsel you to take a look at this. And you might see this here and think, oh, this is one that would have been potential entry too, but would I enter there? No. Well, you got the benefit of hindsight. You can say that now. Look what it's done. It took sell side out here and then rally back up in. This is too close in proximity, so it could run above here to take out buy side and not get this high. So I would want to go into a lower time frame and look for something a little bit higher than this, or study and see if there's anything more in this area here as another fair value gap that may not be seen or visible in this 1 minute chart. I'll drop down into a lower time frame. We'll go into a 10-second chart and show you what that looks like in a minute. But the market breaks lower and does in fact trade back down into this inefficiency and rebalances price action right at that real liquidity void, trading down into 41.53 3/4. Now the question is, does it offer 10 handles or 10 points in range for potential high probability shorting? Because we've already hit our objective, the buy sell liquidity pool. Remember, that was the target we had last night. I gave you that. It hit that, and it hit it during the PM session, 2 o'clock on a Thursday. Thursdays can generally, not always, generally give you the opposite end of a range. Since we've been bullish all week, chances are we can create the high of the week in Thursday. Doesn't mean it will always. It's just many times it'll give you trades that are very short term and give you this type of movement here. We eventually try to go back up again, but it's enough to be paid on it, right? Silver bullet, 10 handle range. Does it offer that? Well, if we're going short here at this candle's high, 41.69, all it needs to do is book and print 41.69 and the spread should fill you. Being short, it does more than that with this here. We're going to assume this is not a real trade here. This is just for annotation purposes, so that we can do the same thing in your journaling. This is where you would be filled. This is how much heat you would have taken or drawdown. And then the market breaks lower. And as the market trades into the lower end or consequent encroachment of this inefficiency, that would be about right here, the spread would probably be required on this candle here. Notice I'm not drawing it on the lowest candle, which is impractical. I'm showing you where, this is how you want to do your own back testing. Annotate where you would have been filled. Do not try to pick the highest high and the lowest low. That's not going to do anything for you. That's not going to make you a super trader. Okay, it's not going to make you that precise because you see it in your charts annotated that way. Be realistic and practical when you're doing your back testing. Where your orders would have been filled, using the logic and the rules I'm giving you, that's what you annotate. And then that way you can study with realistic expectations how much heat or drawdown that your entries would have incurred. You can see that that's not the actual high. A little bit more heat is given before it drops down. Now, right away, I'm reading your mind. I'm getting an impression now that you're thinking, why wouldn't you expect it to completely go all up here and close that in? Well, what did this run here do? It ran the target that I gave you last night. It ran buy side liquidity, and it did so energetically. And then we created this gap here. So this is a blow off type move. It's kind of like capitulation. I'm not suggesting that we've made the high. I'm trading it and showing you with the expectation that we can treat it that way. And this is much like a breakaway gap. This gap should not completely close in. Notice that it came back up later on, but it didn't completely close it in. It left some portion of it open still right there. But we only need 10 handles to see if it's going to offer us opportunity between 2 o'clock and 3 o'clock. The range entry from 41.69 even, which would be this candle's high here. If we were getting short there, 10 handles lower or 10 points lower, which would be 41.59. 41.59 is down here. We haven't even taken out that low to get 41.59 yet, and we're aiming for this. So yes, it would be a high probability trade. So 41.69 to 41.59, there's 10 handles. You can book 5, take a partial at 10, and see if you can get down into this closure of this inefficiency, but I would aim just for that real liquidity void. I wouldn't aim for the low. Even though it did offer it, I would be closing right there as it got into that. So I'd be out there, or best case scenario, that one. And I would miss any further down movement here. And then I would be not engaging at all in any of this. Everything I just showed you, now we're looking at on a 10-second chart. So here's that inefficiency. You can see it's one single candle here. And then your fill would be there. That was where you'd be filled. And this is the heat you took on it, or how much it would be losing against the open position short. You have an up close candle here. This is a bearish order block. The market trades lower. See this inefficiency? That did not exist on a 1-minute chart. This is the 1-minute fair value gap. After it took off below this low here, went down, and then ripped higher back up into the order block. And look at the inefficiency here. See that? Went into it, touched the order block, traded sideways a little bit, broke down back into the high of the fair value gap, and then repriced lower. Then we started respecting that 1-minute fair value gap here, and then we left it. Breakaway gap. Moves lower, digs into that real liquidity void, which was about halfway of that pink area. If you just looked at all these levels here, and I showed you this chart like this, it'd be like, man, what is going on here? What is all this stuff on the chart? It's insight that I see without having it on my chart. I have these levels annotated. And as I'm watching price, I'm constantly referring to, okay, the 4160.75 level is the high of the Wednesday, Thursday opening range gap. So as we're trading down, I'm expecting, okay, I want to see how it trades there. It hits it, comes back up, fills in a little fair value gap. That's normal. Strong break lower. Okay, as it's breaking strong, I'm looking at this ghost image of the previous opening range gap. I want to see, does it dig into that? Yes, it does. And also, it digs into the new day opening gap. So all these levels I'm watching. I want to see it go a little bit more. I want to see a little bit more. Every time it reaches into one of these levels or another PD array that I may have interest in, I'm anticipating some measure of retracement. And if there's an inefficiency just formed, I'm expecting it to reach back up into that like it's doing here, and then digging down deeper. And this is where I would have had my exit as it traded into that real liquidity void, or that separation in between the two candles, which is right there. So all this congestion in here, that's being shown on a 10-second chart all through here. But this level of detail, you can't glean that from a simple 1-minute chart. You don't need this to be profitable. You don't need this to find silver bullet trades that work. But I will find trades that won't exist in a 1-minute chart by using sub 1 minute. I mean something less than 1 minute. And I'm comfortable with that. You may not be comfortable. Just because I can do it, just because I like it, just because I've been doing it, does not mean that I'm twisting your arm saying that you have to do it too. All these things work. You don't even need to be trading with intraday charts. You could be trading with a daily chart. You don't need to do intraday. I teach intraday because it gives me a lot of examples and a lot of opportunity to present things that would take a long time to manifest on higher time frame daily and weekly charts. So, and because it fits my personality, I'm comfortable with making high frequency decisions. And high frequency trading is done on these sub 1 minute candlesticks. They're using these types of inefficiencies and points of reference for their algorithm. They're only shorting when the market goes up. They're only going long when the market goes down. And they're reading inside of all this. Remember, just because it's doing all these fair value gaps here doesn't mean anything. Just because it went up to this order block here doesn't mean anything apart from the fact that we went into that buy side liquidity, which is the level I said we would run into, which we did here at 2 o'clock up here. Once it did that and then it broke aggressively right there, I want to see does it get back below that high, which is this blue line. It does. It breaks down below it, overshoots this inefficiency, even on a 10-second chart, and digs down into the volume imbalance right there. There's no bodies overlapping. It's just a wick. Boom, it hits that. Then it runs one more time back up into the 1 minute fair value gap, which is here, boom, boom, 3 times. This is the 3 drives pattern, very classic pattern. Then breaks lower, inefficiency. I like that one. That could be a short. I would be adding to that. My stop would be above here. But what happens if you would have got stopped out, ICT? Then I would have waited for something like this to occur later over here. Once it broke down and created another fair value gap, I would be shorting there and adding it just the way I've just explained it here. So here's what I've just taught you tonight. Obviously, I taught you a greater degree of precision and why I do my entries where you see me entering them on a 1-minute chart or a 5-minute chart. It may not seem logical to you, but I'm looking at these lower 1 minute and less charts. And I'm looking at all the inefficiencies, the order blocks, the point of reference that I'm showing you here. There's just an introduction to it. Every PD array that I've taught, plus the ones that I will never teach you, I'm looking for them. You don't need all that stuff. But I can teach you how to do this, but you have to be willing to listen. You have to go into the charts and look for it. Silver bullets are simply fair value gaps that exist inside of a 60-minute window. There's not a one-trick pony to silver bullet. There's a lot of ways to get into a silver bullet trade. There's more than one silver bullet forming. That's why I said there's always one forming. You might look at the chart. I've seen people already say, I looked at this, it didn't form. This doesn't work. He said it forms every day. You're not looking at these time frames. They're every day, every single day, between 10 o'clock and 11, and between 2 o'clock and 3 o'clock, and between 3 o'clock and 4 o'clock during the London session. Every single day. But you have to know where it's drawing to. We were expecting it to draw above to get the buy side here. It's done that. So once it's done that, what are we expecting? It's probably going to pull back and offer some measure of retracement. That's reasonable. And it gives it. That's all you need. You need movement. Does it offer you 10 handles? If you're trying to get 5 handles, which is what the model teaches, this is how you get it every single day. You'll lose sometimes. I lose sometimes. I get stopped out sometimes. But if I get stopped out and the criteria is still existing in the price charts and nothing really changed, I just had, a run of, poor execution on my stop placement, or maybe my execution entry wasn't as pristine as I'd like it to be, and I get stopped out. If the trade still is viable, I will re-enter, and you've seen me do that also in my execution videos. So just because I get stopped out or you get stopped out, if the trade still exists in the framework and the logic is still there, look for the next signal to get in on it. You don't need to chase it. Just go on these 1 minute or less time frames and wait for your setup. Think about it like this. If I saw this order block, say for instance I was looking at this area here and I hadn't been in front of the charts until there. I see the order block. Okay, I want to see it reject that. It does. Then we create this little fair value gap right there. When it ran up into it there, and it's the high that I said I want to see the buy side taken on, that right there is an entry for me. I don't need to be in it here. I don't need to be in it over here. I could be in it right there, and that's not chasing price. I could be using this order block right here because we haven't even taken out this low right here. We have an up close candle, and this is all during 10 seconds. I'm watching all this stuff. This up close candle, when we traded away from it and came back up into it here, as this candle's hitting it, I can be short right there. And my stop will be above the fair value gap candle here, right there. My stop will be right there. That's ultra tight. And I could pyramid more. I could be shorting here, pyramiding more here. Because I haven't taken out a structured low that would see acceleration for my trade. And I'm way down here before I get to my target. So in the scheme of things, I'm entering here and my target's here. So this is inception. This is terminus. Midpoint or equilibrium is right here. So I can absolutely take this trade because it's above equilibrium or still in a short-term premium. Ooh, see that? That's institutional order flow, folks. It has nothing to do with volume profile, has nothing to do with level 2 data, DOMs, depth of market, none of that stuff. You don't need any of that stuff. But you do need to know where price is drawing to. Where is it going to next? It's going there for stops, or it's going there because it needs to reprice and re-deliver where inefficiency exists. That's it. That's all it's doing. If it's not going to do either one of those things, guess what it's going to do? It's going to go sideways, and you can't make money in that. There it is. So that's going to be it for this week. Hopefully you've learned something this week, and enjoy your weekend. Be safe. and I'll touch base with you again on Tuesday. Until I talk to you then, be safe.